Welcome to the Vaughan Nelson podcast. Today is the Vaughan Nelson International second quarter 2026 recap. And with me today is portfolio manager Adam Rich. Welcome, Adam.
Thanks, Dan. Great to be here.
All right, Adam, let's just dive right into the quarter. Let's get into the capital allocation framework like we always do. Can you just give us a quick reminder to the listeners on how the capital allocation framework evaluates investment opportunities, why your process focuses on where returns on invested capital are improving rather than simply where companies are investing the most?
Yeah. So we believe that companies that are improving their return on invested capital are dramatically mispriced in the market. We see that in the United States, and we especially see that outside the United States. And one of the key reasons why that is what the market does is it takes the returns and the capital allocation of the company in the past, and then it forecasts that forward. But change is where things are really hard. So what we try to find are companies who are accelerating investment in a focused way that will drive higher return on invested capital. And those companies are dramatically mispriced in the market.
Great, thank you. All right, stepping into allocation effect for the quarter. This quarter, industry positioning was a bit of a headwind relative to the benchmark, and yet avoided some industries. Yet avoided industries continued to contribute positively. Can you explain what drove those two very different outcomes and why disciplined avoidance remains an important part of your investment process?
Yeah, look, I think the two things with allocation that I think are pretty interesting. So we track industries that we don't own, so avoided industries, and that was actually a positive contributor during the quarter. And so, when you think about the capital allocation framework and what it's designed to do, it's supposed to help us find the best companies and the best industries and avoid industries where there's too much capital going into them and returns are falling. By avoiding those industries, we can pick up alpha. And so this quarter, we did pick up positive benefit from avoiding industries with those dynamics. However, our allocation effect was actually a pretty big drag this quarter for us. Allocation was close to down 800 basis points, and that is primarily driven by one issue, and that was we were underweight Korea for most of the quarter, and Korea absolutely ripped during the quarter, and so we had a pretty big drag from allocation from that.
And then looking at stock selection, despite a challenging quarter relative to the benchmark, stock selection remained positive. Where did individual company selection add the most value, and what differentiated those businesses from the rest of the market?
Yeah, this was the highlight of the quarter. Selection effect was positive, close to 200 basis points for us. And look, I think this is the point of the capital allocation framework. I know I brought it up multiple times already, but we're trying to find the best companies and the best industries. And in this particular quarter, we had some pretty good highlights. Siemens, UBS, and International Container Terminal Service. It's ticker ICT in the Philippines. Those were our three big winners during the quarter. But we also had some detractors, right? And the largest detractors were Shopify, New, and SK Hynix. But what the characteristic all of them have, and it's hard to time these, the same characteristic is that they're all investing in something that's going to drive higher returns. And so with Siemens, they're investing in 800 volt. With UBS, they've done the big investment with Credit Suisse. And with ICT, they have deployed capital in acquiring more ports over the past few years, and that's really what's driving earnings. On the flip side, the detractors, Shopify with Agentic, New expanding into new regions, and SK Hynix with HBM. So, all in all, we're really excited for the stocks that we own and the selection benefit we had this quarter.
And then talking about a little bit further on into that, your top contributor, top detractor, they actually shared something fairly similar in common. They're both investing aggressively for the future. What does Siemens and Shopify tell us about the different ways long-term capital allocation can influence short-term performance?
Siemens is a large organization. It has so many different business lines. What they've been doing over the past few years, which is one of the things we love, is when a company starts focusing, a company that's had diffuse investments who's now starting to focus, right? So they're spinning out some businesses and they're taking the proceeds and they're reinvesting into a lot of their key advantages that they have. So they have a great advantage in 800 volts. They do it in multiple different business lines already. And NVIDIA has come to them and has really really using them to help architecture the next generation data centers, the scale up that everyone keeps talking about right now. And this technology is really key. And Siemens is the company who's behind them, who's really behind all this big investment. That doesn't start until 2027, right? And that'll be a 5 year, maybe even longer upgrade cycle that they should really benefit from. And then the second thing that's great with them is that they have this massive data set, and NVIDIA and them are working together to build industrial AI. AI right now has obviously worked in a few industries, and industrial AI is still really early on, but they're investing behind that. So we still haven't seen the fruit there, but the market's starting to really be excited about that. Shopify, on the other hand, is investing in agentic AI. It's really surprising to us how much the market's penalizing the company right now. So this past quarter, they had to spend more money on compute for agentic AI and just different AI purposes that they had, and the market didn't like the margin profile. But that's pretty standard, right? If a company misses on margins, this stock gets penalized. And so we love the long term outlook here. It's probably going to take a few years until agentic commerce really hits scale that it matters for Shopify.
And then look at some of the new positions in the portfolio. Many of those are tied to AI infrastructure, networking, enterprise software, digital platforms. What changed in your research that gave you greater conviction that these businesses can earn higher returns than you previously expected?
Yeah, we were cautious on these names, and the big issue that we saw was that fundraising was going to be pretty hard, and fundraising was needed in order for the acceleration of investment to continue. And so, what surprised us this quarter was how many companies came to market. And in particular, the one turning event for us was when Google came out, who's got a great balance sheet, who's able to issue all this debt, and they came out and they raised equity, 80 billion. And then we saw, SpaceX and a lot more companies be able to raise a lot of money. And so we think that was for us a signal that this investment trend is not stopping, at least for the next 12 to 18 months. And so that was pretty key. The second thing is we're actually seeing return on ROI, or return on investment for this AI spend. We're actually seeing that now in the data. And so we actually think in 27 and 28, a lot of this investment is going to show up with expanded cash flows, and the market's going to be pretty surprised by that. So we're pretty excited about these names. They sold off dramatically during the quarter, and so we were taking advantage of that because we think the next few years is great.
And then looking across your five highest conviction holdings, top five holdings, what characteristics are you seeing that give you confidence that these companies can continue improving returns on invested capital over the next several years?
The market has been so volatile the past 8 weeks. Some of the biggest stock dispersion we have ever seen, and you can see a trend that stock dispersion. So while the underlying index may not be moving that much, stock dispersion trends continue to accelerate. And what I think is going on there, and there's a lot of different reasons for that, but I think what's happening is that the market is giving us some great opportunities for companies over the next 2 to 3 years, and in particular, the top five that we own: SK Hynix, Siemens. We talked about Acton. We'll talk about those three first. They all have the same benefit, which is they're just getting more content on every GPU for the next 3 to 5 years. And then the other two names, Zurn is an insurance company. They're making an interesting acquisition with Beasley that we think is going to be a great deployment of capital, higher return on invested capital for the company. And AstraZeneca, which has a great pipeline that we're really excited about. Although there's some recent news there that's creating some headwinds there. But those top five we're really excited about.
Last thing, outlook. So one of the biggest challenges this quarter was improving your outlook for the AI investment cycle. What changed in the underlying economics? How does that capital allocation framework help you distinguish between durable improvements in return potential and temporary market enthusiasm?
I think from an outlook standpoint, what's really interesting right now is the numbers are just eye popping how much people are investing. We've got trillion-dollar businesses that are investing trillion-dollar amounts. And what's been surprising to us is even with that amount of spend, you would think that returns would be falling, and that's not happening. And so the data for us is showing that we are actually getting better returns, and we're probably going to get better returns than during the cloud cycle that a lot of these hyperscalers spent money on. And so that's really exciting for us. When an industry can invest and expand its returns, that tends to be a great opportunity for years to come.
Well, great. Well, thank you so much, Adam. And with that, we will shift over to returns. In the second quarter of 2026, the Vaughan Nelson International Strategy returned 7.26% gross, 7.00% net, and the MSCI ACWI ex-US index returned 14.49%, which brings the year-to-date return for the Vaughan Nelson International Strategy to 11.6% gross, 11.05% net, and the MSCI ACWI ex-US index is at 13.68%. Over the past 1 year, Vaughan Nelson International Strategy has returned 32.69% gross, 31.39% net, and the MSCI ACWI index ex-US is at 27.66%. And finally, since inception, the Vaughan Nelson International Strategy has returned 29.1% gross, 27.84% net, and the MSCI ACWI ex-US index is at 20.36%. With that, that's a wrap on the second quarter. So thank you so much, Adam, and we'll have you back after the third.
The views, information, and/or opinions expressed during this podcast are solely those of the individuals involved and do not necessarily represent those of Vaughan Nelson and its employees. Vaughan Nelson does not verify and assumes no responsibility for the accuracy of any of the information contained in the podcast. The primary purpose of the information, opinions, and thoughts presented in this podcast is to educate and inform. This podcast, or any podcast in the series, does not constitute professional investment advice or services, and any reliance on the information provided is done at your own risk. Past performance is not an indication of future performance. By accessing this podcast, you acknowledge that the entire contents of this podcast are the property of Vaughan Nelson or used by Vaughan Nelson with permission and are protected under U.S. copyright and trademark laws. Securities discussed within this podcast may be held in the Vaughan Nelson strategies.